Okay, paying the minimum payments on your credit cards monthly. What? You're telling me that you're making the minimum payment on your credit cards? Well, let's get into this one. Why my strong reaction to that? Well, one, quite a few Americans are in credit card debt. Just to tell you a few statistics, the average American family carries about $6,000 in credit cards debt. $6,000, okay? And a little over 10% of those people are making just the minimum payment, okay? When you go further into those stats, there are some that are making more than a minimum payment, but 50%, well actually it's now 48%, but almost 50% of Americans are carrying a balance month to month. You know, think about this. That means that if you were at a function somewhere, let's say that you're at the doctor's office waiting to go into the doctor's office, and you know how it's packed there at the doctor's office sometimes, and you're sitting there for about an hour. Well, you can look on your left and you can look on your right, and one of those folks is carrying a credit card balance. This is somewhat alarming. To jump back into that statistic where the average family is carrying, or household is carrying $6,000 worth of credit card debt. Well, it gets a little worse here if you're making a minimum payment on that. Let's say that minimum payment is right around 3%. That means that it would take you about 25 years or a little over that to pay that off. And on top of that, you're going to end up paying over $17,000 on that $6,000. Let that sink in. $17,000 on $6,000 that you had to spend now, you're going to be paying for 25 years if you make a minimum payment at 3%, and it's going to be over $17,000 for that initial $6,000 taken out. That's insanity. So a lot of people find themselves in this position, okay? Right now it's February 8th, and an event's going to happen tomorrow, the Super Bowl, okay? And from what I understand, it's the Kansas City Chiefs and the Philadelphia Eagles. I'm not real well versed on football. I don't watch it that much, but I certainly do watch it and go with family members during this time when the Super Bowl is on. And some of you are actually going to go out and purchase a television during this time because you can't watch the Super Bowl on a little screen, right? And I was kind of looking at television. Television range on the lower end anywhere from $500 to over $2,000 for your higher end OLED screens. And some of you have already put a television on a credit card. And you're probably going to make, some of you, minimum payments on that $2,000 television. And if you're on average, you're going to have other things that you purchased on credit cards to hit that $6,000 balance on credit cards. And you'll possibly, if you don't change your perspective on this, will be paying that for years and years and years to come. My suggestion is, don't do that to yourself. Is it that important to have a television that's a little bit bigger than what you have right now just to watch the Super Bowl and to be making payment after payment after payment? Particularly if what you have is already good enough. And most of the time what you have really is good enough. It's just wanting to be maybe a little bit more impressive. Maybe there's folks invited over to your home this time around to actually watch the Super Bowl. So you're thinking that you gotta have something that's a little bit more impressive, that has a bigger screen, maybe better technology, so that they the game so that you're able to watch the game and see the little blades of grass on the screen. Don't do that to yourself. Don't put yourself in a position to where you're paying for something years after you purchased it initially. I'm going to talk about some concepts around credit cards that I think about. I think about the 3 C's, as I call them. C as in cat, the 3 C's of credit cards, okay? The one is convenience. Credit cards are convenient, okay? One, because whenever you're purchasing things, like online, the credit card is an easy way to just kind of purchase things online. And if there is anything like fraud or anything else that happens, then it's not directly hitting your bank account like with a debit card. So there's that convenience. And credit cards are taken everywhere. So you can book a flight or rent a car or whatever you need to do on a credit card. So it's convenient, okay? And being convenient is a great thing. In fact, I use credit cards, okay? But I only use them for the cash back, and I only buy things that I would buy anyway. But that number one is a credit card is convenient. But number two is the problem, okay? Credit cards allow you what I call to kick the can down the road. So you can purchase something right now, and then you can kind of kick the can down the road for later and not make the full payment of it now. I listened to a YouTuber that says that if you can't buy 1 or 5 of something, rather, if you can't buy 5, then don't buy 1, okay? So don't kick that can down the road. Make sure that you have the full amount to pay for whatever you're buying right now, okay? Right this moment. You have the cash available to actually pay for that. So that's number two, kicking the can down the road. Puts you in the position to where you may be accumulating this credit card debt that you're paying for long term, like we talked about, the $6,000, only paying the minimum payment of 3% and being in that debt and paying that for 25 years and paying a total with interest of over $17,000 on $6,000 worth of purchases. So think about that, kicking the can. So that's the second concept, okay? And now the third concept is cash. Okay? I would like to frame it in and have you to think about, or at least put in your critical thinking, to think of the credit card as if it's cash. When you go to the register to pay for something, think about it as cash. If that cash isn't in your pocket to pay it right away, or at least that month, or it isn't in your bank account and is going to pay off that credit card, then don't buy it. Just don't get it. It is cash. When you give that credit card to the cashier, if you don't have the money to bag it up, then it's as if you don't even have the credit card. That's the way you kind of have to get it in your mind so that you're not tricked into being in debt, okay? So that you're not tricked into working up a balance that you're paying over a long, long period of time, okay? So that's the other concept. Think of the credit card as cash, okay? Because for me, and I know I can't convince everyone of this as far as using credit cards, I have one reason and maybe two reasons to use credit cards. One, convenience, like I talked about. And for me, I like using cash back credit cards on things that I would purchase anyway. For me personally, I'm paid weekly. So the credit card gets paid off every single week, like clockwork without fail. And in fact, I promised myself that if I come across 1 week, even 1 week, where I do not pay that credit card off in full, it's getting cut up. It's getting thrown out. I'm going to get rid of that account. Why would I do that? I'm hard on myself like that because I know that the traps that consumers fall into with credit cards, buying more than what you need, slowly letting the balance go up and get to a point to where you're part of the 6,000 plus even out there balance that many Americans have on these credit cards, okay? You do not want to be a part of that statistic. You do not want to be carrying those type of balances month to month, being part of that statistic of 50%, well, it's 48%, but close to 50% of Americans carrying a balance on their credit cards month to month. You just don't want that to be a part of your financial legacy. Like, I just shake my head thinking about that. $6,000 debt, paying it for 25 years on the minimum payment, and then $17,000 that you're paying total after interest. You want to avoid being in that bucket or that category, okay? So what do you want to do instead, okay? Because there's another event that's happening right now. People are getting their W-2 statements on their job, and they're getting ready to go to the tax office, do their taxes, and get a tax return. That's happening right now. I'm seeing it at work. People rushing in to go to the printers, to get that printed off, to get that juicy income tax check that's going to come shortly, okay? Think about it. If you're not in a position where your finances are kind of under control, what should you do with that tax return when you actually receive it? Well, let's go through the basics, okay? A foundational thing that you need to do is to have an emergency fund, a quick little baby emergency fund that you can grab if anything happens. If your car won't start and you need to get another battery or an alternator or something else bigger happens with your car, so that you have that baby emergency fund. I suggest $2,000 for that. Many will receive an income tax check of higher than $2,000, okay? So what I suggest is put that in something like a high yield savings account to get a little bit of interest on that money. But even if you just put it in a regular savings account at your bank, it's not going to give you much interest, but it gets you that baby emergency fund started. Then what I would suggest is taking a look at if you have a company match in a retirement program like a 401k at your work. Take advantage of that. And then you want to start to get rid of the consumer debt. Again, you get that tax return, why not put it towards the consumer debt? If you got credit card debt, here's the other thing. I just looked at it. Credit card debts, credit card companies, on average now, have 25% interest on those cards. I'm about to have an aneurysm even thinking about that, 25%. I get excited about an S&P 500 fund that since its inception has returned about 10%, okay? And that's exciting to me. I'm like, wow. I'm trying to get young people to invest in an S&P 500 fund because I know that at 20 years old, if the S&P 500 index fund does what it has done since its inception, which is about a 10% return, they put $100 a month into that, they're going to retire at 65 millionaires. So I'm excited about that. Yet your credit card company, on average, is charging you 25% interest using that compounding interest in not in your favor, but against you. Against you. So you really got to think about that. 25% interest is crazy. That's insane. You do not want that working against you. You want to use that money from your tax return to get rid of that kind of debt, to wipe it out as quickly as you possibly can, okay? So we were talking about basics. Again, to review real quick, $2,000 emergency fund. Take advantage of a company match if you have that at work. 3, getting that 3 to 6 month emergency fund, okay? And then after that, working on building wealth with something like paper assets. I suggest index funds for many people, an S&P 500 index fund or a total stock market fund to start building wealth, okay? Now enjoy the Super Bowl game that's coming up tomorrow. Have fun. But don't get caught up in the credit card trap to buy stuff like a big screen television, okay? And as your tax returns come in, start to think about the basics. How can you go through steps to get yourself from where you're at to a better financial future, and hopefully getting to the point of building some wealth so that you can retire with dignity, okay? I'm not even talking about retiring extravagantly, but with dignity. Think about these things. Put it in your critical thinking and do what it takes to put yourself in a better financial situation in the future. Thanks again for listening.